All right, so looking at any kind of financial media today, if you hadn't been around for the past few days, you would think, oh, we really must have had a significant sell-off with the types of headlines that we've seen and the reactions we've seen across, say, Twitter and things like that. So I'm going to break down today's selling and see how much of a sell-off it really was and what it looks like in context of the rest of the moves we've seen lately and what it means. Does it mean that the bullish rally is now done? Does it mean that a pullback is starting? We're going to take a look at the technicals and see if that's what they're saying. And we're also going to take a look at a trade that is not really, it kind of follows the same thing that we've been doing a lot lately, where we don't really want to chase a directional move to the upside, but we don't want to bank on a pullback move, directional move to the downside either. So how do we trade in this environment? And we'll follow that same theme with today's trade idea. So let's go ahead and get started. Today is Wednesday, June the 24th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 here with the market forecast indicator. As you can see, the downward move today got us to the moving average, did not get us through the moving average. We have light pink shading, and that means the intermediate line turned back down. The momentum line fell, did not get to an extreme low point, did not get to an overbought high either again. The near-term line fell again from a bearish near-term high, or what could be a bearish near-term high between the 50th and 80th percentiles, but coming off a bullish low. So we're not really bullish, not really bearish. And hey, that's something I've told you before. When you're between 0 and 23%, you just go up and down. There's no rhyme or reason. It's really easy to go up. It's really easy to go down. And so right now, we're in a down phase off of the lows here, and that helps us to avoid just barely the moving average today was at 30.42.22. We finished at 30.50.33, so just barely finishing above the high point there on the S&P. You can see the Russell 2000 did not. It actually did form light pink shading in the yellow line. Again, typically can be considered a bullish pattern. We'll see how that plays out here tomorrow. Again, oversold momentum line, but not at the lows, so not as bad as it could have been. The near-term line also dropping down below the chart's midpoint. Again, not producing a bullish high point, but also coming off of a bullish low point. So it's, it kind of shows just how sideways that is. The Nasdaq, on the other hand, a little bit of a evening star candlestick pattern, as much as you can create out of that. It's not nearly as bullish. In fact, this is bearish. This is as bullish of a short-term pattern as you can get. You have strong bullish posture still, so no light pink shading here. Strong. The intermediate line's easily above 80. The near-term line's coming down from an overbought level, so it's a bullish sign. And is obviously between 20 and 50 would be setting up for a bullish low point. And the near-term line, the momentum line, the red line, is down below the 20th percentile, but not an extreme low. So this would constitute a bullish intermediate confirmation signal, similar to what we saw over here. Hit a little bit more of an extreme low on this down day. Took a couple of days to really get going, but similar pattern. And you can see it. The Nasdaq is also between its 0 and 23%. In fact, we kind of have to move this back down. I was kind of flirting today with where it could go up to if it were to continue this trend. Let's bring this back down to here. Let's move this over to that low, and this would be to that high. And again, you can see this Fibonacci retracement is based on breaking through the 100% level and continuing higher. Here, let me do this back to auto. So there's the 0 to 23% line too, and towards the upper end of that level, and not looking like a bearish pattern whatsoever. If it did fall below, if it did fall to the 23%, which remember it can do really easily, it would also be producing at least a yellow line if it closed there, if not light pink shading as well, depending upon how fast the intermediate line falls. It fell pretty quickly here, It took a couple of days, and that's it, for it to get to a light pink shading there. So obviously the Dow continues to be the most bullish. The Russell continues to be most bearish. The S&P kind of caught in the middle. But like I said before, between 0 and 23, there's not much change in trend. Once you break the 23% level, now we're talking about something different. In fact, you'll notice there's another reason why that's significant, because the point of control for the 1-year volume profile is also sitting at the 23%. So there's some very significant support in that area. And even if we fell down to the 32, there's also some volume support with multiple touches in this area as well. So the S&P it's going to be hard for it to really kind of break down here versus something like, say, QQQ, which will not be so hard if I were to activate this and move this up. Oops. Activate this up here, move it up to the high point now. You can kind of see there's a volume node at the 23%, and the top of the value area is sitting at the 38%. So, it also has some very strong support. So, I tweeted this out. There's actually a picture of the family from last night getting together, but I tweeted this out here. If you believe that every down move is the start of a major sell-off, and every up move is a blow off top or too far too fast, you have an erroneous investment philosophy. So the first half of that would apply to this. If every time we have a down day, in fact, I tweeted out also here, the closing bell program on CNBC started off with this line: we have a huge sell-off on our hands. And again, you say, okay, huge sell-off. If you look at the daily percent moves here, it was down more than 2%, but we were just down more than 5% about a week ago. And we've had multiple 2%. In fact, these were all huge sell-offs, all below 3, multiples below 2. So this is nothing new. The VIX didn't even go up very much. It didn't even gap down very much. So this wasn't very much of a quote-unquote huge sell-off. And as I mentioned, nothing's huge until you break support. Right, and so just the hugeness of today's drop is just a reflection of how wide the gap is between its 0 and 23 levels. Opens you up for, and for that matter, how persistently high the VIX is. It opens you up for bigger moves. It looks a lot bigger compared to some of these down days that we had late last year and early this year, but compared to earlier down days, just in this current rally, intermediate rally, doesn't look very big at all. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us here on YouTube. Also, while you're down there, hit the thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another one tomorrow. It's a quick way to give us feedback. Let us know that you like our videos. You can do that with one click right now. If you don't like our videos, you don't have to click on anything. Also, comment. What questions or comments do you have about anything I talk about in these videos? Post those in the comment section down below. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter at DavidSettle42 for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're looking at us here on our blog post, here's our Market Outlook live trade review link. Click on this image there to watch our live videos that we do. When I do the Market Outlooks on the same day, I also do a Market Outlook live video where I review all the old trades that we put on here and close any that need to be closed and discuss the management of any that we continue to trade going forward from here. There's also our upcoming classes. Brandon has his Q&A session for our premium subscribers tomorrow. Our plus subscribers, which are our monthly subscribers, they get access to all of our trading rooms. So here's our next couple of trading rooms here, as well as our live trade review videos. Also engage with us on social media here. Click this heart. It opens up a new window, and click on the like button there. Also click on this thumbs up. It takes you to a Facebook page where you can click on that thumbs up there and like today's Facebook post as well. Again, that benefits us because the more likes these posts have, the more Twitter and Facebook will promote our content to all of our followers on those accounts. It benefits you because the more Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us here. All right, let's get back to the charts here. Let's take a look at the long-term chart. And you'll notice now, with today's move, we got a lower shadow on this weekly candle. So we have another transition candle. It ends up, whether it's red or not, will depend upon how we finish the week. You can see where the 23% retracement level is of this rally. You can also see right here, well, actually this is at 23% level of this rally move up to the upside. So again, there's lots of ups and downs, and you can get transitions in this period, and you can, again, if we pull to the 38%, then you're going to get some bearish candles. If we don't, then we'll get some bullish candles to the upside. Otherwise, we'll get transitions in the middle. And again, the issue is that, there's such a large gap between the 0 and 23, and that's a function of how big this rally's been. And that's what makes these bigger moves seem like more than they are, because they're really not much more. The size is all a function of the previous rally, this run that we've had. You can see the golden cross that we have too, showing and still being above the 50-day moving average shows the bullish trend that we're on, even if we have 3 red arrows. You can see SPY showing us 3 red arrows, which can be a very bullish signal. When you get the 3 red arrows, you can bounce right off of that and make another leg higher on this current intermediate run. You can see we did drop below, obviously, the 17-day moving average. So like we talked about before, we got to get right back above it by the end of the week. If not tomorrow, then Friday. We need to get back above it. If we don't, then we know that this bearishness that we're getting here on both the MACD and the stochastics, as well as the RSI and CCI, will be more bearish than this. You can see right now, neither, they're all pointed lower, but they're not bearish. None of these oscillators are bearish. Even the DMI, shows, the negative index got above 30 again. It's done this before, but like it did before, the positive index didn't really drop very much with the ADX down as low as it is. You look at the Ichimoku cloud, and we're easily above the cloud. We're only dipping below. We still have very strong trend according to these 2 indicators. We just dip below the blue line, which is very similar to a 3 red arrow pattern. You look at the Bollinger Bands, and you can see, like I said, we're not through the value area yet, but we're above the point of control with some very strong support below us. So, again, we've had a decline, but not a significant enough decline to suggest that we should be more bearish. It was really nothing. It's not a huge sell-off like it is on TV. It's it's a down day. We've seen bigger down days than this in the more recent history. We've seen down days like this on this rally, and so we dipped below into the lower half of the Fibonacci retracement zone. We did that before, and like we did before, we didn't dip into the lower quartile, which would suggest the potential for us to be more bearish than this. So again, you can see we're down, but we're not bearish on any of these indicators. All right, let's take a look at the intraday charts. You can see where we fell down to. There's a nice little layer of intraday volume with this little node here building out throughout the day today. Also getting to the bottom of the value area. We had broken through the top of the value area briefly here, but not by very much, as you can tell, since the value area moved up to that high from yesterday. But with today's low, we came down to the bottom. So, and there's your 23% Fibonacci retracement. So there's a little bit of, we can come down probably towards 300, a little bit more by the time this little selling is done before we get going back up again. If you look at, again, relatively big down day today, a little bit above average, 132 million. You look at the range today, 8 points, which doesn't include the gap, so 312 to 310.5, so about another 1.5 there. So we ended up with about 10 points and 132 million shares traded. So you put that in context. 10 points is up here, 132 million is right here. So both numbers back up above. And so if we get another day like today, tomorrow, then that will be more bearish and probably lead us towards that 23, if not a little bit through it. If we go right back down to a smaller range and smaller volume, then we'll start continue to grind our way to the downside. We talked about the VIX. The VIX had been briefly, trying to get back to the upside. Nice thing about today's move on the VIX is we got back up to this range right about in this area here on the last pop that we had on June the 11th. Now that finished with a move up a lot higher by the end of the day, but at that point you can see the VIX had cleared the 100% mark and then made its way up to the 105% mark before pulling back at the end. Here at the same level, instead of getting up to the 100% mark right there, we stopped well short of it. So it kind of again shows us how not very volatile this drop is. It was this far even less volatile than the last drop towards these lows. So this last little dip that we had on the 11th, so right here, this drop is not nearly as bad as the previous one was up to this point. That was a lot more bearish. We had a much bigger gap to the downside. We had a much bigger move, and still haven't filled in that all the way that gap there. So it puts today's move in a much different context, much smaller gap. Still a pretty decent sized move that ended right about where the European session closed, and then we didn't go anywhere. Whereas over here, we got to the European close and continue to go down all the way to the low point. So much different day, not nearly as bearish of a day as what we saw back there. And that one ended, right? We set the low point there a couple days later and then came off of it pretty easily. So it goes to show, just again, how not very bearish that move was. All right, so to summarize our technical outlook before we look at some of these other markets here, again, we've been strongly bullish. There's going to be some breathers without necessarily even a pullback. We still haven't really had a pullback yet, and today's move, as of right now, doesn't show any signs of it being a pullback. Again, it's just we're in an area of the chart where it's pretty noisy to the upside and to the downside. And today was just a noisy move down. We've had some noisy moves up, and this one is a noisy move down. And as of right now, it's nothing more than that. We don't expect it to be. There's especially considering the very strong support levels we have around these 23 and 38% levels that can keep us up in these areas. So the expectation is we'll probably bounce off of this going into the end of the week. And if we do, we're back to normal, back above the 8-day moving average, and here we go. If we don't, then we know going into next week we're probably going to have some issues. We're probably will end up having the beginnings of some kind of intermediate pullback. So very, very important couple of days left. Again, like I said, with my expectation that we'll probably end up bouncing back up here and finishing back towards where we started today, if not a little bit higher, but at least to where we started today and back up towards the moves and the highs that we had, and filling in the gap that we had this morning, and probably not much more than that, because we're not getting a lot of bullish signals right now either until we break back above the 0%, like we did just recently this week on the Nasdaq 100. So what do you think? Do you agree with that or disagree? Comment down below. If you disagree, comment down below as to what you're seeing that suggests either you're a lot more bearish already than I am, or you're even putting less stock into this little pullback that we've had, this little drop that we've had today, than even I am, and that you're a lot more bullish. So whatever's driving your opinion there, whatever chart or indicator you're looking at that drives that, share with us down below. All right, one of the moves that we've noted here yesterday or earlier this week was the dollar, and the dollar getting back below its 8-day moving average. Well, today we bounced right back up above. Again, bullish. The MACD is above its moving average, stochastics, but we're not breaking back above the 17. We're not changing the trend, and we are above the 23% retracement level, but we're still holding. We held support once at the 38%. We'll see if we end up holding it again. Let's see whether yesterday's move was the anomaly, which I don't think it was, or whether today's move was the anomaly, which I do think it is. So we'll see how that plays out here in the next couple of days. Let's take a look at the 10-year yield, which continues to be as flat as a pancake. In fact, if you look at the DMI for the 10-year yield, which you can because it's got a range, right? You can see just how low. I mean, there's just literally no trend on there. It's about as low as it can possibly be. So when you look at something like that and you see, okay, how much this is really not moving at all, the 10-year yield, and when you look at the compression over a short time frame here, you can see it's really come down. It's about as small of a range in a short time frame as you could possibly have. There's the actual range, and then there's the average. Again, if you look at it, all the way back, it's about the highs that it had been before on a relative basis. On an absolute basis, you can kind of see it down here, but on a relative basis now, in terms of this range that we've had since it really took off and got much bigger, it's really compressed down to the downside. And the last time we compressed this much, we had to jump up to the upside, and we'll see if that continues to be the case again for yields. The other big mover we've been seeing here this week is the commodity basket. And the commodity basket is kind of giving us a little bit of a divergence here and potentially moving its way back towards the moving average. But like we see with the Nasdaq, this is a bullish intermediate confirmation signal. An overbought, near strong bullish posture, oversold near-term line, oversold momentum line, but not necessarily to extreme levels, and a near-term line that's between 20 and 50, setting up for a potential bounce to the upside. So we'll see again if this ends up bouncing back up. If you look at the two-line version of its MACD and stochastic indicators, you see that we basically dipped below the 17 barely. So we either bounce back up off of this and get back above the moving average line, and stochastics bounces back up, or we don't by the end of the week, and we get a lot more bearish and have a little bit of an intermediate pullback. So that's kind of confirming what we're seeing across different asset classes right now. If you look at I've shown you this chart last time, all the major ETFs, or all the biggest economies, which are all dark green and shading green lines. Now we've got light pink across the board, with a few dark green still in India and China and South Korea and Russia, but mostly light pink with some yellow lines, UK, Canada, showing us some yellow lines here. So some weakness reflecting what we're seeing in the S&P, and we'll see whether any of these will turn into a dark pink shading. The closest one that we have is the UK turning into dark pink shading, and again, that would be a reflection of risk appetite waning, but it kind of looks like we're getting this buy the dip signal all across the board from an equity standpoint. Now let's take a look at how the sectors have done these first few days of the week. Here, let's go to change the time frame here to the 22nd. There we go. Go to the 10-minute chart. There's our pullback there, and you can see it's still a XLK, XLY, XLC driven market, right? And energy is the biggest decliner, industrials and financials are the biggest losers. So again, even during the pullback, our leadership still remains in these QQQ type names, and that's a good sign. That's what we want to see, right? When we pull back without those names leading the way, when they drop the most, now that's when we have some concerns, right? Because when we start having significant pullbacks with XLK leading the way to the downside, then we know we are starting to make our move where here this outperformance of QQQ relative to IWM is going to start working its way on a longer term basis to the downside. Right now that's not the case. We're still moving up on this parabolic move of QQQ relative to IWM. When we get pullbacks, if the pullbacks are led down by these smaller cap sectors, industrials, financials especially, then we know, okay, this is an energy for that matter too, then that's typical. This is typical of a decline, and this is what we saw in March, and we bounced right off of that low point in March with these QQQ names leading the way higher initially, we would expect the same thing to happen again. Obviously on a much smaller scale because we haven't even broken the 23% retracement level here. Alright, so for our trade idea of the day, let's take a look at a stock that's been relatively sideways itself in that healthcare area, and that's United Healthcare. You can see how like we've got dark pink shading, light pink shading, light green shading, dark green shading, yellow line, red line, green line, yellow line. I mean, that's about as sideways as you could possibly get on a market forecast chart. You know, if you take a look at its long-term chart here, you can see that we are still bullish though. We have a golden cross. We're at the 50-day moving average, even if we're losing some long-term momentum. If you take a look at its 3 green arrow chart, you can see its moving averages are pretty much all converging right on top of each other here. You take a look at its Bollinger Bands, and you can also see too, we have some resistance up here to the ups, or excuse me, you have this big volume node that we're basically kind of the singular volume node. We have another one down here further, but we've got this big one here that we're kind of gravitating. We're sticking around with this gravitational pull with with a relatively low bandwidth compared to what we've seen here recently, as well as a really low ADX. You can see its ADX has gotten to its lowest point, which again signifies that there is no trend on this stock. You look at its Ichimoku cloud here. You are above the cloud still, so we're not bearish at all here. If anything, a bullish bias, but you notice we have a very, very weak bullish trend, and what was a strong bullish trend now is nothing, right? Very, very weak. So weak trends lends itself to doing a iron condor trade. In this case, we sold the 310, sold the 270 put, 310 call, went $10 wide in either direction to protect that. That gave us for a small risk. This is about 2/3 of what I normally put on risk for our class portfolio, getting about $350 of reward. Being willing to lose up to $350, $346 out of that 654 if it doesn't work out, if we do make a directional move one way or the other. If we stay right here, we get a pretty decent reward for the small risk that we're taking. Alright, and that does it for today. So you heard from me now I want to hear from you. Use that link popping out in the top right corner of your screen to go to our Market Outlook forums. Open up any new thread with any questions or comments you have on anything we talked about in today's video. Reply to anybody else's thread as well. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between videos. Join our website at marketscholars.com, as well as our Facebook group we've created. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.